I've watched many speculative manias unfold over the course of my investing career, and an equal number of subsequent busts. It never fails. People tend to make their investment decisions based upon what is hot now, which is about as foolish as driving based solely upon what a person sees in the rearview mirror. For example, after a number of years of stocks going up, people will take for granted that they will continue to do so indefinitely. They will start to buy stocks with reckless abandon and dream of untold riches and a leisurely retirement. Usually the trend continues for a couple of years, and they start to feel like geniuses. They might even go so far as to enlighten others with their stock investing wisdom, or even chide those who decide to invest their wealth in other ways. Inevitably, the boom leads to bust, and the geniuses end up having their genius heads handed to them. Of course, this pattern does not only apply to stocks. Silver, and to a lesser extent gold, had speculative manias leading into 2011. There were lots of newcomers who saw the price of gold and silver climbing quickly, and they jumped into the pool head first, without first checking to see if there was water in the pool. The price trend validated their decision, at least for a little while, and it allowed those who invested in gold and silver to feel pretty smart. But, as inevitably happens, the subsequent years proved to be very disappointing. There was always a tendency on the part of people to base their choices of investment on what's been hot lately. Nothing attracts attention like a rocketing price. The trouble is that it's usually dangerous to join the company of those who feel very smug about their investment success. There is a particular asset which comes to mind, whose recent gains have made the holders feel particularly brilliant, but I won't take away valuable time from this video discussing it. All I have to say about it is that driving based upon the rearview mirror is generally most dangerous when the car tachometer is redlining. Anyway, this boom and bust thing is one of the reasons why I try to do the math and base my decisions on the analysis instead of upon emotion and price trend. The math is not always precise. In fact, I can usually count on it being wrong in the short term, but it's served to keep me out of trouble, and it's generally been right in the long term. I've developed lots of different ways of analyzing gold. Some metrics are based upon comparing gold to commodities. Some are based upon analyzing sovereign debt levels, but there is yet another that I haven't discussed much. It's based upon the speculative tendencies that lead to boom and bust. Here is a chart that highlights this tendency of the cycle. What I have plotted is the 10-year annual rate of return of stocks and bonds against the annual rate of return of gold. The data goes back to 1968, and so there are lots of 10-year periods that serve as data points. The stock versus gold points are blue, and the bond versus gold points are red. Notice that when bond returns are above average, stock returns also tend to be above average, and when bond returns are below average, stock returns tend to be below average too. So bonds and stocks are not quite as uncorrelated as financial experts would have you believe. On the other hand, notice that financial assets and gold tend to be negatively correlated. This should come as no surprise. After all, gold tends to be shunned when it appears that financial assets are the surefire way to build effortless wealth, and it tends to be popular when confidence in financial assets wanes. So it follows that one metric that we can use to determine the desirability of gold is the likely future returns on stocks and bonds. Those who hold gold will likely benefit handsomely if in the next decade the geniuses in the financial markets are humbled and have their heads handed to them. We can see this counter-cyclical behavior at work with a few examples. Let's look at the 1980s decade first, which started with stock and bond holders feeling pretty humble and gold and silver holders feeling pretty smart. In hindsight, it was a terrible time to own metals and a pretty good time to be holding financial assets. The S&P 500 returned a CPI-adjusted 11.3% per year, and the 10-year Treasury returned an adjusted 5.7% per year. This was a pretty impressive showing. Gold, by contrast, declined by nearly 10% per year on a CPI-adjusted basis. Notice that the points are very close to the trend line. If a gold investor could have predicted the future returns on bonds and stocks at the beginning of that decade, he or she could have avoided a lot of pain by getting out ahead of the trend. Could the investor have predicted these future returns? I'd argue that the answer was yes, and I'll show you how in a few minutes. In moving to the 90s, we see that it was still a pretty rough decade for gold, even though it had already declined in price quite substantially. The main reason for this was the continued high performance of stocks and bonds, which drew even more people into financial assets and soured people's opinions even further on gold. Stocks returned an even more impressive 15.9% per year, and bonds returned 5.6% per year. The higher stocks went, the more people were drawn in. And gold? Well, let me tell you what it felt like buying gold and silver in the late 90s, because I remember. I'd have to listen to people who were getting rich tell me about how great a company WorldCom was, or Qualcomm, how they were getting rich in AOL or Palm. And as a side note, remember Palm Pilots? Few people do today, but those who bought the stock back then felt like geniuses, and the price action reinforced their belief. I didn't dare mention to anybody that I was buying silver. I would have appeared to have been completely stupid. Just the same, silver felt like a safer place to be back then. The late 90s were a trying time, but patience was rewarded handsomely. And math proved to be right in the long run. It usually is. I kind of wish that I could go back in time and buy silver again at $4 to $5 an ounce. My investing back then was one hell of a workout. Fast forward to the 2000s. Stocks had a terrible decade. The average return was minus 3.9% per year on a CPI-adjusted basis. There was a short-term bull market in the middle of the 2000s, but the general trend on an inflation-adjusted basis was down. It was a trying time for stock investors, and the frustration of the stock investors eventually led to metals looking more attractive. And as more people bought metals, their price started rising, and as the price rose, more people bought. It was a self-reinforcing cycle. Gold had a CPI-adjusted return of 11.5% per year, and silver did even better, especially leading into early 2011. So one can see how extreme returns in financial assets, either good or bad, leads to either a favorable or unfavorable move in the price of gold. This is just yet another tool by which the safety of gold and silver can be assessed. Let's see what happened in the most recent decade. The last 10 years were kind of ho-hum for financial assets. Stocks returned a CPI-adjusted rate of 6.3% per year, and bonds returned 2.6% per year. Gold was somewhat ho-hum as well. It returned about 3.2% per year. All the same, notice that the stock and bond versus gold points are fairly close to the trend lines. Can we use this information to help us ascertain what the next decade might hold in store? I think we can. We can fairly easily estimate the CPI-adjusted return of bonds. The current yield on 10-year TIPS, or Treasury inflation-protected securities, is 0.5% per year. This means that 10-year TIPS investors are guaranteed to get a 0.5% CPI-adjusted return before taxes. Investors in 10-year traditional treasuries are also expecting pretty much the same inflation-adjusted return. After all, if they expect TIPS to produce a superior return, they'd buy TIPS instead of traditional treasuries. So if, as I show here by a dashed red line, we trace over the expected 0.5% per year rate of return on bonds over to the red solid trend line, and then drop the vertical, we can see that the correlation predicts that gold should have a 14 to 15% per year real annual return over the coming decade. This is quite a satisfactory rate of return. Relative to bonds, gold is actually more favorably valued than it was at the beginning of the bull market in the 2000s. Silver too, even though I'm not showing it on the chart. But bonds are only one of the two financial assets that we need to be concerned with. Is there a way to predict how stocks are likely to perform in the coming decade? Absolutely. It's not a perfect predictor, but it's had a good track record, and it's based upon solid reasoning. Many years ago, Robert Shiller published his work on what he called the cyclically adjusted PE ratio, or CAPE. Essentially what CAPE does is it takes the most recent 10 years worth of earnings from S&P index companies, adjusts them based upon the consumer price index, and averages them to come up with an expected average earnings level for all companies in the S&P 500 index. It then compares the price level of the S&P against these earnings. So it's like a price to earnings ratio, but volatility in earnings is averaged out. The higher the CAPE ratio, the more expensive stocks are relative to their earnings, and the less likely it is that stocks will perform well over the coming decade. We can see how CAPE over the last few decades have predicted good and bad times for stocks. See how high CAPE was in 1929? Well, we all know what happened afterwards. Similarly, we can see how CAPE hit peaks in the late 60s and the late 90s. The following decades for stocks were pretty poor. Right now, CAPE stands at about 32. It's not as high as the level reached in the late 90s, but it's certainly as high as it was in 1929 and higher than the level reached in the late 60s before the bear market of the 70s. So we can expect that stock returns going forward are going to be disappointing. We can't guarantee it, but we can expect returns to be subpar, at least for the long run. Can we put a number to it? Sure. Here's a plot of the CAPE values for stock indices in various countries, plotted against subsequent returns. In this case, the returns are over 15-year periods of time, not 10, but the annual returns should be fairly similar over a 10 or 15-year time horizon. There is a correlation which can be determined based upon these points. It's not perfect, but it explains about 58% of the observed volatility of annual returns. Referring to this correlation, we can see that with the current CAPE ratio of 32, the expected annual return over the next decade and a half is about 1 to 2% per year. It certainly won't be 1 to 2% per year each and every year. There will probably be years where the return will be 5 to 10%, maybe more. Otherwise, nobody would continue to hold stocks. Just like in the 2000s, it will likely be that stocks will rise and fall and rise and fall. Then again, all of the pain might be experienced over the first few years. But over the next 10 to 15 years, returns will likely be just a little bit north of zero. And of course, after those holding stocks lose their faith in the financial vehicles, they will probably turn their attention to gold. And as they are drawn in, the price of gold will rise relative to the financial assets as the financial assets sell off. And if stock returns are 1 to 2% per year on average, then it's likely that gold will rise by about 10% per year, according to this correlation. This is an imprecise estimate, but at least it serves us as a guidepost for decision making. Let's combine this information with what we believe the return on bonds is likely to be. Notice here that when we combine the prediction for stock and bond returns on the same chart, it shows that gold is likely to return somewhere between 10 to 15% per year on a CPI adjusted basis. I think this is a pretty good bet because both of the chief financial assets are very richly valued today and likely to disappoint many investors going forward. And as they lose their faith in paper, they will likely turn their attention toward gold and silver. So if you are currently buying gold and silver and are afraid of telling anyone because only stupid people buy anything that is not Facebook, Apple, Netflix, or Google, take heart. The tide is bound to turn, and when it does, just remember not to gloat, because for all things there is a season. Instead, just quietly reposition your wealth and enjoy the party, and smile to yourself as you listen to the other guests brag about the latest hot investment.